The world stands at the edge of uncertainty, and with a single decision, the tides of history can shift. Trade is not just about numbers on a chart. It's about people, livelihoods, and the delicate balance that holds economies together. When leaders impose sweeping tariffs, it's not just a policy move. It's a ripple effect that can shake industries, businesses, and everyday families to their core. For decades, the global economy has been built on cooperation, trust, and the idea that prosperity is shared. But now, a storm is brewing, one that threatens to divide nations and ignite tensions that could spiral beyond control. Is this a bold move toward economic strength or a dangerous gamble that could backfire? The stakes couldn't be higher. The markets are watching. Investors are holding their breath. Businesses are scrambling to prepare for the unknown. And those who have seen the past repeat itself know that actions like these have consequences far beyond what anyone can predict. The question now is, are we stepping into a new era of economic warfare, or is there still time to change course before history writes another painful lesson? The world stands at the edge of uncertainty, and with a single decision, the tides of history can shift. Trade is not just about numbers on a chart. It's about people, livelihoods, and the delicate balance that holds economies together. When leaders impose sweeping tariffs, it's not just a policy move. It's a ripple effect that can shake industries, businesses, and everyday families to their core. Tariffs as economic warfare. Trade policies are not just economic tools. They can escalate tensions, disrupt global supply chains, and be perceived as acts of economic aggression. Market uncertainty and investor reactions, sudden tariff announcements create volatility in financial markets, affecting stocks, currencies, and investor confidence worldwide. Impact on businesses and consumers. Increased tariffs often lead to higher costs for businesses, which are then passed down to consumers, resulting in inflation and reduced purchasing power. Global trade relationships at risk. Retaliatory tariffs from other nations can damage diplomatic ties, reduce exports, and isolate economies, leading to long-term economic consequences. Lessons from history. Previous trade wars have shown that protectionist policies can backfire, slowing economic growth and causing unintended consequences for both domestic and global markets. For decades, the global economy has been built on cooperation, trust, and the idea that prosperity is shared. But now a storm is brewing, one that threatens to divide nations and ignite tensions that could spiral beyond control. Is this a bold move toward economic strength or a dangerous gamble that could backfire? The stakes couldn't be higher. The markets are watching. Investors are holding their breath. Businesses are scrambling to prepare for the unknown. And those who have seen the past repeat itself know that actions like these have consequences far beyond what anyone can predict. The question now is, are we stepping into a new era of economic warfare, or is there still time to change course before history writes another painful lesson? Trade has always been more than just an exchange of goods. It is a reflection of global cooperation, economic stability, and geopolitical power. When tariffs are used as a weapon, they transform into something far greater than financial policies. They become instruments of economic warfare. Throughout history, nations have relied on tariffs to protect their industries, but when applied aggressively, they can trigger economic conflicts that spiral beyond control. At its core, a tariff is a tax on imported goods meant to encourage domestic production and reduce dependence on foreign markets. While this may seem like a protective measure for a country's economy, the reality is far more complex. When one nation imposes high tariffs, others respond in kind, leading to escalating trade disputes that can damage economies on both sides. This tit-for-tat approach, known as a trade war, has been witnessed multiple times throughout history, often leading to disastrous consequences. It is a high-stakes game where businesses, workers, and consumers all pay the price. The economic battlefield created by tariffs is not confined to the companies that import and export goods. Entire industries can be thrown into chaos as supply chains are disrupted and production costs rise. Companies that rely on imported materials suddenly find themselves paying more, forcing them to either pass these costs on to consumers or absorb the losses, which can threaten jobs and business stability. Small and mid-sized businesses, which often operate on thin profit margins, are especially vulnerable as they do not have the financial cushion to withstand sudden economic shocks. When tariffs are imposed on major industries such as steel, automobiles, or technology, the ripple effects can spread across the entire economy. Manufacturers that depend on foreign raw materials are hit with higher costs, making it more expensive to produce goods domestically. This weakens global trade partnerships, reduces efficiency, and forces businesses to rethink their investment strategies. Many companies may even seek alternative markets to avoid tariff-heavy trade routes, further shifting economic power on a global scale. Internationally, the perception of tariffs as an act of economic aggression can have far-reaching diplomatic consequences. Trade is deeply intertwined with political relationships, and when one country implements aggressive tariff policies, it risks damaging alliances that have been built over decades. Nations that once worked together may begin to see each other as economic adversaries, fueling tensions that extend beyond commerce and into the political sphere. This shift can impact everything from foreign policy decisions to military alliances as economic trust erodes and competition replaces cooperation. For everyday consumers, the effects of tariffs are often felt in higher prices and reduced purchasing power. When the cost of imported goods rises, retailers are forced to adjust their prices accordingly, leading to inflation and a decline in affordability. Essential products, from food to electronics, can suddenly become more expensive, placing financial strain on families. Consumers may cut back on spending, which in turn slows economic growth as businesses see reduced demand for their products and services. The long-term impact can be devastating, leading to lower wages, job losses, and economic stagnation. While the intention behind tariffs may be to strengthen domestic industries, the reality is that they often backfire, hurting the very people they are meant to protect. Many businesses rely on a combination of domestic and international resources to remain competitive, and abrupt policy shifts can force them into difficult decisions, such as layoffs or relocating operations to other countries where trade restrictions are less severe. This counteracts the initial goal of tariffs and can lead to unintended economic consequences that harm the broader economy. History has shown that aggressive tariff policies have the potential to push nations into prolonged economic battles with no clear winners. Once countries engage in economic retaliation, the situation becomes difficult to de-escalate, leading to a cycle of rising tariffs and declining trade. This creates an environment of uncertainty, making businesses hesitant to invest and expand, ultimately slowing down economic progress. The consequences of these policies are not always immediate, but over time they accumulate, leaving lasting damage that takes years or even decades to repair. Investing is not a short sprint, it is a marathon that requires patience, discipline, and a long-term vision. Many people enter the stock market hoping to make quick gains, buying and selling based on daily fluctuations, news headlines, or social media trends. However, this approach is often driven by emotions rather than logic, leading to impulsive decisions that can result in heavy losses. The most successful investors, on the other hand, understand that true wealth is built over time. Instead of focusing on short-term price movements, they concentrate on the long-term potential of their investments, allowing their money to grow steadily over years, even decades. The power of long-term investing lies in the concept of compounding. Compounding allows money to grow exponentially over time as gains continue to generate further gains. When an investor reinvests dividends and allows profits to accumulate, their wealth builds upon itself. The longer the time horizon, the more significant the impact of compounding. Many people underestimate this principle, expecting quick returns and ignoring the incredible power of patience. But those who stay committed to their investments, even through market downturns, often achieve far greater financial success than those who constantly buy and sell in an attempt to time the market. One of the biggest challenges in maintaining a long-term vision is dealing with market volatility. Stock prices fluctuate daily due to a wide range of factors: economic reports, political events, interest rate changes, and investor sentiment. It is easy to feel anxious when the market declines, and many investors panic, selling their stocks at a loss. However, those who understand the value of a long-term perspective see market downturns as opportunities rather than setbacks. Instead of reacting emotionally, they remain calm, recognizing that short-term volatility is a natural part of the investment journey. Historically, the stock market has experienced numerous corrections and crashes, yet has always recovered and continued its upward trajectory over the long run. A crucial aspect of long-term investing is selecting businesses that have the potential to grow and sustain profitability for years, rather than chasing the latest trends or speculative stocks. Successful investors look for companies with strong fundamentals, competitive advantages, and consistent earnings growth. These are businesses that provide essential products or services, have a loyal customer base, and can adapt to changing economic conditions. Investing in such companies and holding onto them through market cycles allows investors to benefit from their continued success. Another important factor is ignoring short-term noise. The financial media is filled with daily predictions, market forecasts, and sensational headlines that can create fear or excitement. Investors who react to every piece of news often make impulsive decisions that hurt their long-term success. True long-term investors, however, do not let temporary setbacks or media speculation dictate their strategy. They stay focused on their investment goals and trust the underlying strength of their chosen businesses. Staying committed to a long-term vision requires confidence in the investment process. It means understanding that there will be periods of uncertainty, but staying the course will yield rewards over time. Many of the greatest investors attribute their success not to making perfect market calls, but to simply staying invested and letting time work in their favor. Those who jump in and out of the market trying to predict short-term movements often miss out on the best days of growth and end up with lower returns. The essence of long-term investing is patience and trust in the power of time. Instead of looking for overnight success, those who embrace a long-term approach understand that wealth is built gradually. The greatest financial rewards come to those who resist short-term temptations, focus on quality investments, and allow their portfolios to grow uninterrupted for years. When it comes to successful investing, the key is not just buying stocks. It is choosing the right businesses. While many investors focus on market trends, price movements, and short-term opportunities, the real path to long-term wealth lies in selecting companies with strong fundamentals, competitive advantages, and the ability to sustain growth over time. High-quality businesses are the foundation of a solid investment portfolio, providing stability, resilience, and consistent returns even in uncertain market conditions. One of the defining characteristics of a quality business is a strong competitive advantage. Competitive advantage refers to the unique qualities that allow a company to outperform its rivals and maintain its market position. This could be a well-known brand, proprietary technology, cost leadership, or a loyal customer base. Companies with strong competitive advantages can generate steady revenue and profitability regardless of economic downturns or industry changes. They are less vulnerable to competition and have the pricing power to maintain healthy profit margins. Financial strength is another crucial factor in identifying high-quality businesses. A strong balance sheet, low debt levels, and consistent cash flow indicate that a company is financially stable and well-positioned to navigate economic challenges. Businesses with excessive debt or unstable earnings are more likely to struggle during downturns, while those with strong financials can continue to invest in innovation, expansion, and shareholder returns. Investors should carefully analyze a company's financial statements to ensure that it has the ability to sustain long-term growth without taking on unnecessary risks. Sustainability and adaptability are also key traits of quality businesses. The most successful companies are those that can evolve with changing market conditions and consumer preferences. They continuously innovate, expand their product lines, and enter new markets while maintaining their core strengths. Businesses that fail to adapt often lose their relevance and struggle to survive. Investors should look for companies with a history of resilience, strong leadership, and a clear vision for the future. Earnings consistency is another hallmark of a great investment. Companies that generate stable and growing profits over time provide investors with more predictable returns. Unlike speculative stocks that experience wild fluctuations, businesses with reliable earnings are more likely to withstand market volatility. They often distribute dividends, rewarding shareholders with passive income in addition to stock appreciation. This makes them attractive for long-term investors who seek both capital growth and income generation. Investors should also consider the industry in which a company operates. Some industries are more resilient to economic downturns than others. For example, consumer staples, healthcare, and utilities tend to perform well even in recessions because they provide essential goods and services that people need regardless of economic conditions. On the other hand, highly cyclical industries such as luxury goods, travel, and entertainment may be more vulnerable to economic fluctuations. Investing in businesses with a strong market position in stable industries can provide additional security. One of the biggest mistakes investors make is chasing short-term gains by investing in speculative or overhyped stocks. Many companies experience temporary surges in stock prices due to market sentiment, but if their fundamentals are weak, these gains are often short-lived. A stock may be popular today, but if it lacks a sustainable business model, strong leadership, and financial stability, it is unlikely to provide long-term value. This is why thorough research and analysis are essential before making any investment decision. Ultimately, selecting quality businesses requires patience, discipline, and a deep understanding of what makes a company successful. It is not about following market fads or trying to predict short-term price movements. It is about finding businesses that can thrive for years to come. By focusing on financially strong, well-managed, and competitively advantaged companies, investors can build a portfolio that stands the test of time, delivering consistent growth and security even in uncertain market conditions. Investing is not just about making money. It is also about protecting what you already have. No matter how promising an investment seems, there is always some level of risk involved. Markets fluctuate, businesses face challenges, and unexpected economic events can disrupt even the most carefully planned strategies. That is why risk management is a fundamental part of successful investing. While taking calculated risks is necessary to achieve growth, avoiding unnecessary risks and prioritizing capital preservation is what truly sets apart the best investors from the rest.